Okay, imagine this for a second. It's kind of a nightmare scenario, really. You've just sold an investment property, something you've maybe managed for years, right?
Mm-hmm.
And you're counting on deferring what could be a huge tax bill.
Mm-hmm.
We're talking serious capital gains, maybe years of depreciation recapture you've taken. You plan to use a 1031 exchange to roll it all into a new property.
The smart move, usually.
You think you've done your homework, you feel pretty confident. But then, maybe months later, long after you thought it was all buttoned up, you get that dreaded notice.
Uh-oh.
A single, maybe seemingly small mistake, something buried deep in the rules, had disqualified the entire exchange, and that massive tax bill you thought you deferred.
It's due. Right now. Unexpectedly.
Exactly. Ouch.
Yeah, and that's not just theoretical fear-mongering. Sadly, it's a real possibility for investors trying to navigate the very intricate world of 1031 exchanges for U.S. real estate.
It seems like such a powerful tool, the 1031.
Oh, it absolutely is. Incredibly powerful for building wealth, precisely because it lets you defer those taxes. But that power is locked behind some really strict, really unforgiving rules. Like you said, the cost of getting it wrong can be just staggering.
It's like having this amazing financial engine, but you miss one tiny step in the operating manual and boom, the whole thing just seizes up painfully.
That's a good analogy.
So today we're doing a deep dive. We've got a stack of sources here, articles, research from experts, insights from people deep in the 1031 trenches, and they really lay bare the most common and often the most costly mistakes investors make.
Yeah, and our mission here is really to unpack these pitfalls. We want to understand why they happen, get to the root cause and pull out the crucial insights you need to avoid them.
Right, because it's not just about knowing the rules exist.
Exactly. It's about executing them perfectly to actually get that tax deferral benefit and protect your whole investment strategy long term.
Okay, let's get into it then. Let's unpack this.
Let's do it.
So maybe before we jump into the mistakes, let's just quickly ground ourselves. What is a 1031 exchange, at its core? And why do investors want to use it so badly?
Okay, fundamentally, a 1031 exchange comes from Section 131 of the U.S. Internal Revenue Code. Basically, it lets an investor sell one investment property, we'll call that the relinquished property, and then acquire another piece of like-kind investment property, the replacement property, all while pushing off, deferring the capital gains tax and that depreciation recapture tax you'd normally have to pay right when you sell the first one.
So it's officially a tax-deferred, like-kind exchange.
That's the formal name, yep.
But people call it other things too, right? I've heard delayed exchange, deferred exchange, starker exchange.
Yeah, starker exchange comes from a landmark court case, but they all mean the same thing. You're deferring taxes by swapping one qualifying investment property for another.
And the big why for investors, it's not just a tax loophole, is it? It's strategic.
Oh, absolutely strategic. Investors use 1031s for some major advantages. Maybe you want to trade up, sell a smaller property, buy a bigger, more valuable one.
Above the ladder.
Right. Or maybe consolidate, sell off 3 small rentals and buy one larger apartment building that's easier to manage. Could be about increasing cash flow, moving your investments to a different city or state, or even just changing property types within real estate, like moving from retail into industrial, perhaps.
Lots of reasons.
But the engine driving all of that is the tax deferral. Because you defer the tax, you get to reinvest the entire amount of your equity and sale proceeds into that new property.
So the money that would have gone to Uncle Sam
stays in your deal, working for you. Yeah. It's essentially like getting an interest-free loan from the government on the taxes you would have paid. This lets your capital grow and compound much, much faster over time compared to if you paid the tax up front and only reinvested what was left over.
Okay, yeah, I can definitely see the power in that, keeping the whole sum working. But, like you said, strict rules. So let's talk about the absolute must-have, the foundational things you have to get right. First one seems to be this idea of qualified use property.
Yeah, this is totally non-negotiable. And honestly, it's where things can go wrong right from the very start. For a property to even be eligible for a 1031, both the one you're selling the relinquished and the one you're buying the replacement must be held for productive use in a trade or business or for investment.
Okay, so right off the bat, your personal house is out.
Totally out. Your primary residence where you live doesn't qualify. 1031 is strictly for business or investment properties.
And the sources we looked at really hammer home the intent aspect. It's not just what the property is, but why you're holding it.
That is the absolute crucial piece. The IRS isn't just looking at, is it a building? They're looking at your intent. If you buy a place specifically to fix it up fast and sell it, Flipping.
Flipping, yeah.
That's generally seen as inventory. Property held primarily for sale in the ordinary course of business. And that kind of property typically does not qualify for a 1031. Your intent needs to be longer-term investment or use in your business.
What about, say, buying an apartment building? But the plan all along is to convert it to condos and sell those individually.
Yeah, again, that scenario, based on the sources, really points towards the property being held for sale, not for investment. The intent when you bought it and how you treated it while you owned it is absolutely key.
Okay, intent is huge. But how does the IRS figure out your intent? Is there like a magic number, like you have to own it for 5 years or something?
That's where it gets a little less black and white in the actual regulations, but tax pros and court cases give us a lot of guidance. The rules themselves don't actually state a minimum holding period, but the length of time you hold the property, that's a major factor the IRS looks at.
So if you buy it and try to exchange it right away.
Yeah, or sell it really quickly after you buy it, that looks an awful lot like you bought it to sell it, not to hold it as an investment.
Makes sense. So no hard rule, but definitely a strong recommendation.
Exactly. The experts looking at IRS guidance, court cases, even old legislative proposals and recent IRS comments, they strongly suggest holding investment property for at least 12 to 24 months, often longer, really, to build a solid case for investment intent.
12 to 24 months. Why that specific window?
Well, a few reasons come up in the sources. Holding for at least 12 months lines up with the minimum time needed for long-term capital gains treatment. That's kind of a signal the tax code uses anyway to separate short-term speculation from longer-term investing.
Okay.
And holding for, say, 12 to 24 months means the property's life as an investment, the rent coming in, the expenses, the depreciation you're claiming will show up on at least 2, maybe even 3 of your tax returns.
It creates a paper trail.
Precisely. A clear, documented history supporting your claim that you held it for investment. Plus, the sources mentioned Congress kicked around a 12-month statutory hold period idea once, and the IRS has kind of alluded to 24 months in some contexts recently. So going 12, 24 months or more just gives you a much stronger position if anyone ever questions your intent.
Right, build that track record. Now, what about properties held inside entities, like a partnership or a corporation or a multi-member LLC? Does the qualified use rule apply to the entity itself or the individual owners?
Ooh, yeah, this is critical and trips up a lot of people. If the partnership, the LLC, owns the qualified investment real estate, then generally the entity can do a 1031. It sells its property, it buys new qualified property, fine.
Okay.
However, the individual ownership interest in those entities, like your share as a partner or your membership interest in the LLC, those are usually classified as personal property.
Okay, I see the trap. And personal property. It's mostly out for 1031s now, right?
Exactly. Since the big tax changes in 2017, 1031 exchanges are pretty much restricted to real property only. So you generally cannot exchange your personal property interest in an entity that owns real estate for a piece of actual real estate that you want to own directly in your own name.
Wow. So partners or LLC members who want to go their separate ways using a 1031 have a big problem.
A major hurdle. The sources really stress you have to plan for this proactively, like way before you even think about selling the property. It often means complex restructuring of the entity or the ownership, and you absolutely need expert legal advice to figure that out. Waiting until you have a buyer lined up, usually way too late to fix it properly.
That is a really important nuance. Okay, what about vacation homes or second homes? Not your primary residence, but you might use them personally sometimes, rent them out other times?
Yeah, the IRS actually gave specific guidance on this. It's a safe harbor rule, Revenue Procedure 2008-16. For one of these properties to potentially qualify for a 1031, you need to show it was held primarily for investment. The rule says you need to have owned it for at least 24 months right before the exchange.
Okay, 2 years.
And within each of those 2 12-month periods, you have to rent it out at fair market value for at least 14 days.
Rent it for 14 days a year minimum.
Right. And here's the kicker. Your personal use during each of those 12-month blocks can't be more than 14 days or 10% of the number of days it was actually rented out at fair value, whichever number is greater.
Wow, that's specific. 14 days or 10% of rented days, max personal use.
Very specific. It's a formula designed to prove the primary purpose was investment, even with some personal enjoyment mixed in.
Okay, so qualified use is job 1. Prove intent, Follow the holding guidelines. Watch out for entity issues and vacation home rules.
Got it. What about the like-kind part? There's this myth you have to swap an apartment building for another apartment building, right? That is such a common misconception, and the sources are really clear on this, at least when we're talking about real property. For real estate, like-kind is actually incredibly broad. Pretty much any type of real property held for investment or used in a business is considered like-kind to almost any other type of real property held for investment or business use.
Seriously. So I could sell raw land.
And buy a strip mall. Yep.
Or trade an office building for a warehouse.
Absolutely. Or a rental house for farmland. As long as both properties are legally classified as real property and both meet that qualified use test we just talked about held for investment or business, they're considered like-kind for 1031. The actual type of real estate doesn't have to match at all.
That opens up way more possibilities than people might think.
Right.
Portfolio changes, strategy shifts. Okay. But you stressed real estate. What about personal property?
Right, like we touched on with the entity interests. The rules for personal property are way more restrictive. And frankly, since 2017, 1031 for most types of personal property is just gone, eliminated. There might be some super narrow exceptions left, but the general rule now is 1031 is for real property. Even before the law changed, the like-kind rule for personal property was much tighter, trading a business truck for another business truck or one specific type of machine for a very similar machine. And you could never exchange personal property for real property in a 1031. That was never allowed.
Okay. So for real estate investors listening, the main takeaway is like-kind is broad for real estate. But if your deal involves any personal property, like maybe furniture in a furnished rental, or equipment in a commercial building, that's a red flag.
Huge red flag. If personal property is part of the sale or purchase alongside the real estate, you need to talk to your QI and tax advisor immediately to see how or even if it can be handled. It complicates things.
All right. So we've got qualified use, like-kind for real estate. What else is absolutely crucial for making the exchange work and, actually deferring that tax bill?
Okay. To get full tax deferral, 100% deferral, you have to nail the money side. Specifically, value, equity, and debt. The basic rule is you must acquire replacement property that's equal to or greater in value than the relinquished property you sold.
The total value, not just the profit.
Correct. Total value, usually based on the net sales price of the property you sold. Second, you have to reinvest all of the net proceeds. That means all the cash, the net equity that comes out of the sale of your old property has to go into the new property.
All the cash, okay.
And third, you generally need to replace the amount of debt that was paid off on the old property when you sold it. You can do this by getting new debt, a new mortgage on the replacement property, or you can just add enough new cash into the purchase of the replacement property to cover that debt amount.
Okay, let me see if I got that. To defer all the tax, buy replacement property of equal or greater value, reinvest all the cash proceeds, and replace any debt paid off, either with new debt or by throwing in more cash.
That's the trifecta for full deferral. If you miss on any of those, say you buy a cheaper property or you take some cash out of the deal or you don't take on enough new debt and don't add cash to cover it, then the amount you fall short by is considered boot.
Boot? Like cowboy boot?
Yeah, just boot. B-O-O-T. It's the technical term for any property you receive in an exchange that is not like-kind. For 1031s, that usually means cash boot actual money you receive, or mortgage boot, which is the debt relief you got by paying off the old loan but didn't replace on the new property.
And boot is bad.
Boot is taxable. Any boot you receive is generally taxed up to the amount of gain you actually realized on the sale. And the sources make a really important point here. You have to reinvest all the net equity. That includes even the original cash down payment you might have put into the relinquished property years ago. If you get that initial investment back as cash during the exchange, that's boot. Taxable boot.
Whoa, okay, that's a really critical detail. Don't assume you can just pull your original stake out tax-free.
Nope. Any cash you receive from the QI during the exchange period is almost certainly taxable boot. The sources are clear. The only safe ways to get cash out of the equity in your property without triggering immediate tax in a 1031 context is to refinance the property, either well before you even start the exchange process, like months before, so it's clearly a separate transaction, or after the entire 1031 exchange is totally finished, meaning you've closed on all your replacement properties.
So refinance before or refinance after.
Right.
But absolutely not during the exchange.
Trying to pull cash out while the exchange is happening or telling the QI to just send you some of the proceeds, that's a guaranteed way to create taxable boot.
Okay, that's crystal clear. Get cash before or after, never during. All right, we've laid out the foundation. Qualified use, like-kind, value, equity, debt rules. Now let's really zero in on the specific mistakes people make that can just kill the whole deal. The sources highlight one that seems fundamental, happens right at the start, simply not using a qualified intermediary.
Yeah, this isn't just like a good idea. For almost all 1031s, especially the common delayed exchange where you sell first and buy later, it's an absolute requirement. You must use a qualified intermediary, or QI. Sometimes they're called an accommodator or facilitator.
And what makes them so essential? What's their job?
The QI is basically the required neutral third party in the whole transaction. They use a series of legal assignment agreements to effectively step into your shoes for the exchange. They handle the transfer of your old property to the buyer and the transfer of the new property from the seller to you. Their main jobs are making sure the exchange is structured correctly according to IRS rules, preparing all the necessary exchange paperwork, and this is huge, receiving, holding, and protecting your exchange funds, the money from selling your old place.
So wait, when I sell my property, the buyer doesn't pay me directly?
No, absolutely not. The closing agent or title company handling your sale must wire the proceeds directly to your QI. That is probably the single most critical administrative step to avoid you having access to the money.
And if you don't use a QI, or maybe you hire one, but they aren't involved correctly right from the beginning.
The result is immediate and fatal for the exchange. If you, the taxpayer, receive those sales proceeds, even for a second, the exchange is dead. It violates the rule against actual or constructive receipt, which we'll probably talk more about. The QI's involvement from day one is the structure that prevents that. And the sources really emphasize the QI must be formally assigned into the purchase and sale agreement, and the closing instructions for every single property involve both the relinquished one you're selling and each replacement property you're buying before any of those closings happen.
Before any closing?
Before. If a closing occurs and the QI wasn't properly assigned into that specific deal beforehand, the exchange fails for that property and maybe the whole thing blows up.
Wow. Okay, so mistake #1 is basically failing to set up the whole structure correctly with that mandatory third party, the QI, right from the absolute start.
Exactly. It's a fundamental process error. You can't fix it after the fact.
All right, mistake #2. This one also happens early and sounds just as fatal if you mess it up, not properly identifying your replacement property.
Yep, this comes directly from one of the most infamous deadlines in the 1031 world. As soon as the sale of your relinquished property closes, a clock starts ticking. You have exactly 45 calendar days.
45 days. Calendar days, you said, not business days.
Calendar days, and the sources could not be clearer.
Wow.
This deadline is absolute, non-negotiable. It cannot be extended. Doesn't matter if the 45th day falls on a Sunday, a national holiday, doesn't matter if there's a blizzard. 45 days is 45 days.
Wow. No wiggle room at all.
None. If you miss that 45-day identification deadline, your exchange is over. Disqualified. Full stop.
Okay, that's incredibly strict. Yeah. And you can't just tell your QI, yeah, I'm thinking about that building on Main Street.
Yeah.
There are specific rules for how you make that identification.
Oh, yeah. Very specific rules from the IRS. You have to follow one of these 3 identification rules.
Okay, what are they?
Rule number 1, the most common, is the 3-property rule. You can identify up to 3 potential replacement properties. Doesn't matter what their value is. You can identify 3 $10 million properties if you want, even if you only sold a $1 million property.
Okay, 3 properties, any value. That seems flexible.
It is. It's popular because it lets you list backups, right? If deal #1 falls through, you have #2 and #3 on your list.
Makes sense. So what's rule 2?
Rule 2 is the 200% rule. If you need to identify more than 3 properties, you can, but the total combined fair market value of all the properties you list can't be more than 200% double the net sales price of the property you relinquished.
Okay. Identify as many as you want, but their total value can't exceed double what you sold.
Right. And rule 3 is the 95% exception rule. This one lets you identify a whole bunch of properties. No limit on number or total value, but there's a big catch. You have to actually end up acquiring replacement properties from that list that have a combined value equal to at least 95% of the total value of all the properties you identified.
Whoa. 95% acquisition requirement. That sounds tough.
It's very tough. That's why it's called the exception rule. It's not used very often because if even one small identified property deal falls apart, it could cause you to fail the 95% test.
Okay, so realistically, most people stick with the 3-property rule, maybe the 200% rule if they need more options?
That's generally true. The 3-property rule usually gives enough flexibility within that super tight 45-day window. But the key, again, is you must make your formal written identification to your QI following one of those rules precisely before midnight on the 45th day.
And can you change your mind after day 45?
Nope. The sources say your identification list is locked in after the 45-day deadline. You can revoke an identification during the 45 days, but once it passes, you can only acquire properties that were on that final list submitted by the deadline.
Okay, so mistake #2, missing the 45-day ID deadline, or messing up the specific identification rules. Both kill the exchange.
Absolutely fatal. Non-recoverable process mistakes.
Got it. Mistake #3 you mentioned briefly earlier, but sounds like it needs reinforcing because it happens a lot. Mixing personal property with business or investment property.
Right. This brings us back to that core qualified use rule. A 1031 exchange is only for property held for investment or used in a business. It is absolutely not for personal stuff like your main home or, say, a boat or even a vacation home that you use mostly for yourself.
And trying to sneak some personal use asset into an otherwise qualifying exchange, that's a no-go.
It can absolutely poison the well. It can disqualify the entire exchange. The sources warn that unless the deal is structured with, like, surgical precision, maybe allocating values, separating out the personal component, which is really complex, it's just asking for trouble.
So it goes back to needing experts again.
Definitely. That vacation home safe harbor rule, Reverend Proc 2008-16, is that very specific, limited case where a property with some personal use might qualify, but only if you rigidly follow those rules about rental days and limited personal use to prove its main purpose really was investment.
Okay, so the clear message is, keep your personal assets completely separate from your 1031 exchange unless you have an expert who has confirmed, based on a specific rule like the vacation home one, that it's okay and has structured it perfectly.
That is absolutely the safest way to think about it. Assume personal property doesn't mix, period, unless an expert tells you otherwise and shows you exactly how.
Which naturally leads us straight into mistake #4. This isn't about a specific step in the process, but more about a failure to get the right help, not consulting with a tax professional and your other key advisors.
You know, this might be the root cause behind many of the other mistakes we're talking about. Every single source we looked at just hammers this point home. 1031 rules are incredibly complex. They're full of nuances, exceptions, weird interactions. They're easy to misunderstand.
So trying to DIY a 1031
is basically playing financial Russian roulette. You absolutely must talk to a qualified tax professional, and not just any tax pro, but someone who really specializes in 1031 exchanges.
So my regular accountant who does my taxes might not be enough.
They might be great at regular taxes, but 1031s are a different beast. An advisor who doesn't handle these all the time could easily miss a critical detail, or maybe not be up on the latest IRS interpretation, and that one missed detail could torpedo the whole exchange. And the sources say don't stop at just the tax pro. You should also be talking to competent legal counsel and likely your financial advisor too.
Okay, why bring in lawyers and financial advisors as well?
Well, legal counsel is crucial for getting the structure right, especially if you have those entity issues we talked about. They need to review and draft the QI assignment agreements correctly, handle title issues, make sure the contracts work for the exchange. Your financial advisor can help you figure out if the 1031 even makes sense in your bigger financial picture. Is this the right move for your overall goals beyond just saving tax today? A good 1031 touches on legal stuff, tax stuff, and financial strategy. You need experts covering all those bases.
Right, so yeah, paying for these experts costs money, obviously. But it sounds like it's nothing compared to the tax hit if you mess up the exchange.
Exactly. The cost of getting disqualified, having to pay all those capital gains and depreciation recapture taxes immediately, that cost is potentially way, way higher than the fees for good advice. Thinking of expert advice as an optional nice-to-have is backwards. It's an essential investment to make sure the exchange actually works. It should honestly be one of your very first calls when you're even considering selling.
Okay, so mistake #4 is skimping on the expert team, specialized tax pro, lawyer, financial advisor. Don't do it. Non-negotiable.
Absolutely essential. Build your team early.
Okay, so beyond those basic requirements and early mistakes, what other traps are hidden in the rules?
Well, there's another big absolute deadline. We talked about the 45-day identification deadline. There's also the 180 calendar day exchange period deadline. Not only do you have to identify within 45 days, you then have to actually acquire and close on one or more of those identified replacement properties no later than 180 calendar days after the day your relinquished property sale closed.
180 days to seal the deal on the new place. Also non-negotiable.
Also, totally non-negotiable. Cannot be extended. But there's a really tricky interaction with your tax return deadline that catches a lot of people. The actual rule says you have to close on the replacement property by the earlier of 180 calendar days, or the due date, including any extensions, of your federal income tax return for the year you sold the relinquished property.
Wait, the earlier of 180 days or your tax filing deadline? Okay, that sounds like a potential landmine. Walk me through that.
Sure. Let's say you sell your relinquished property early in the tax year, maybe in March. Your 180 days will be up sometime in September. That's way before next April 15th when your tax return is due. So in that case, your deadline is simply 180 days, no problem.
Okay.
But let's say you sell your relinquished property late in the year, specifically anytime after October 17th.
October 17th. Why that date? Is that like 180 days before April 15th?
Exactly. If you close your sale after October 17th, your normal tax filing deadline of April 15th of the following year will actually arrive before your full 180-day exchange period is finished.
I see.
So in that situation, your deadline to complete the exchange gets effectively cut short to April 15th, unless you file a timely extension for your federal income tax return.
So you have to file a tax extension to get the full 180 days if you sell late in the year.
You got it. If you sell after October 17th and you don't file for a tax extension, your deadline to buy the replacement property suddenly becomes April 15th or whatever the tax deadline is, which could be significantly less than 180 days.
Wow. That's a huge trap. A late year sale combined with forgetting to file a tax extension could accidentally kill your exchange just because you ran out of time sooner than you thought?
It's a very common and very expensive mistake, yes. Especially when you're already under pressure from the 45-day ID and trying to get deals closed within 180 days anyway.
Okay, so keep track. Strict 45-day ID, strict 180-day acquisition, and watch out for that tax extension requirement for late year sales. What's another big pitfall, maybe related to the money itself?
Yeah, that's the whole issue of actual or constructive receipt of funds. This is the core reason the qualified intermediary is so essential. The rules are absolutely strict. You, the exchanger, cannot have actual physical possession of your exchange funds, nor can you have what's called constructive control over them at any point during the exchange period. That's the time between when your relinquished property closes and when you finally acquire your replacement property.
Okay, actual receipt is easy. The money lands in my bank account. What does constructive receipt mean practically?
Constructive receipt means you don't necessarily have the cash in hand, but you have the power or the legal right to get it or control it. Or if you receive some other kind of economic benefit from those funds while the QI is holding them. For example, if the closing agent wires the money from your sale straight into your personal checking account, even just for a day before you send it to the QI, that's actual receipt. Exchange dead. If your exchange agreement is written poorly, maybe giving you the right to demand the funds from the QI before you buy the replacement property, other than for normal closing costs on the replacement, that could be deemed constructive receipt. Exchange dead. If you use the funds held by the QI to pay off personal debts unrelated to the properties, constructive receipt. Exchange dead.
So the whole QI structure, them holding the money in a segregated account, being formally assigned into the contracts, is specifically designed to build a wall around that money so you can't touch it or control it during the exchange.
Exactly. It's the firewall. The money has to flow directly from the sale closing to the QI, stay with the QI, and then flow directly from the QI to the replacement property closing. Any deviation where you get access or control is fatal.
And you mentioned those entity issues again earlier. That's another recurring pitfall.
Definitely. Trying to do an exchange when the property is owned by a partnership, LLC, or corporation gets complicated fast. The main pitfall, like we said, is trying to exchange your personal property interest in the entity, your partnership share, your LLC membership units for actual real property. That generally doesn't work because 1031 is for real property now.
So the entity itself can exchange its real estate for other real estate.
Usually, yes. But if the individual owners want to split up and go their own ways via 1031, they hit that personal property roadblock. The solutions require serious planning before the sale. Things like maybe dissolving the entity and distributing the property to the owners as tenants in common first. That's called a drop and swap. Or maybe the entity does the exchange first and then distributes the new property, a swap and drop.
Those sound complicated.
They are. And they have their own risks and require careful timing and expert legal advice to make sure you don't trigger taxes accidentally or violate other 1031 rules in the process. Definitely not DIY territory.
Okay, that covers a lot of the pitfalls in a standard or forward exchange where you sell first, then buy. But I know there's this other beast called a reverse 1031 exchange. What's that about, and what are its unique traps?
Right. A reverse 1031 exchange is basically flipping the sequence. You acquire the property, you want the replacement property before you actually sell the property you currently own, the relinquished property.
Why would someone do that? Seems backwards.
Well, think about a really hot real estate market. Finding a good replacement property and getting it under contract within that tight 45-day window after you sell your old one can be super stressful, maybe even impossible. A reverse exchange lets you lock down that perfect replacement property first, then you have time to sell your old one.
Ah, okay. Takes the pressure off finding something quickly. But you said it's more complex and usually costs more. Why?
Because generally, you, the investor, can't hold title to both the old property and the new property at the same time if you want it to qualify as a 1031 exchange. So a reverse exchange needs another party called an exchange accommodation title holder, or EAT.
And EAT. Okay, another acronym. What do they do?
The ET's job is to temporarily park the title to one of the properties. Either they take title to the replacement property you're buying first, or they take title to the relinquished property you haven't sold yet.
Parking the title. How does that work legally?
Typically, the ETT sets up a brand new, separate company, usually a single-member LLC, just for your deal. We call this a special purpose entity, or SPE. The ET holds legal title to the parked property through that SPE. For tax purposes, the ET-SPE is treated as the owner while it's parked there. This structure allows you to move forward with the other side of the deal, either selling your old property if the ET parked the new one, or buying the new property if the ET parked the old one.
And is the EET the same company as the QI you need for the funds?
Sometimes the same company offers both services, but the sources strongly recommend against using the same entity for both roles. It's generally better practice to have a separate, distinct company act as the EAT and another act as the QI. Why? Because the EAT is taking on a lot more risk by actually holding title to property, maybe even taking on debt. Keeping the roles separate provides better risk insulation.
Okay, makes sense. And you said the EIT can park either property, so there are different ways to structure a reverse.
Yeah, two main ways. One, exchange last. This is where the EET buys and parks the replacement property first. You find the property you want, the ET's SPE buys it and holds it. Then you have time to find a buyer and sell your relinquished property. This is often preferred because it solves that finding a replacement in 45 days problem. The downside, getting financing can be trickier because the lender has to lend to the ET's SPE, not directly to you while it's parked. 2. Exchange first. Here, the ET's SPE takes title to and parks your relinquished property, the one you plan to sell. This frees you up to go out and acquire the replacement property directly in your own name. This structure might make it easier to get a regular mortgage on the new property since you'll be the borrower and owner right away. But transferring your old property to the ET's SPE could potentially trigger a due-on-sale clause in your existing mortgage on that property, which could be a big problem.
Okay, so definitely more moving parts, more players, different risks depending on the structure. What are the specific extra costs and risks people should expect with a reverse?
The sources list quite a few. Higher fees. ETs charge significantly more than QIs because they're taking on way more legal liability and financial risk holding title, maybe dealing with loans. More transaction costs. You'll likely have extra costs for things like title insurance just for the ET's short holding period. Legal fees will probably be higher because the documents are more complex. There might be costs if the ET needs to get temporary financing. And this is a big one. There's a potential risk of paying double state or local transfer taxes. Once when the property goes into the ET's SPE, and again when it comes out to you or the final buyer. Though some sources mention ways to potentially mitigate this using agency agreements, but it depends on the state and needs careful planning. No depreciation, this is important. While the ET's SPE holds title to the parked property, nobody gets to take depreciation deductions on it. The ET holds it like inventory, and you only start depreciating it or continue if it was the relinquished property once you take title back or acquire the replacement property fully at the end of the exchange.
Wow, okay. Lots of extra hurdles. And I assume reverse exchanges have strict deadlines too.
Oh, absolutely. And just like forward exchanges, they are non-negotiable calendar day deadlines. They work a bit differently depending on the structure, but the key ones are: if the EET parks the replacement property first, exchange last, you then have 45 calendar days from the date that ET acquired that property to formally identify the relinquished property, or properties you intend to sell. And in either structure, exchange last or exchange first, the relinquished property absolutely must be sold and transferred to an unrelated buyer within 180 calendar days from the date that EV first acquired the parked property.
Okay, so still 45-day and a 180-day clock, but they start when the ET takes title to the parked property. And the 180-day deadline is about getting the sale done.
Exactly right. Miss either deadline, the reverse exchange fails, and you likely face immediate taxes.
Given all that extra complexity, cost, and risk with a formal reverse exchange using an ET, are there maybe simpler ways to handle that timing issue if you find the perfect replacement before you've sold?
Yeah, the sources do suggest looking at alternatives first. Sometimes you can achieve a similar result without the full EAT structure. For instance, maybe you can negotiate with the seller of the property you want to buy for a significantly delayed closing date, giving you time to sell your old property first.
Just kick the can down the road on the purchase.
Right. Or maybe you could use an auction agreement or a lease with an option to tie up the replacement property for a while, again buying you time to sell your relinquished property and then execute a standard forward exchange. These approaches can sometimes avoid the complexity and cost of a formal reverse, but whether they work depends entirely on the deal specifics, how flexible the other party is, and of course, getting it all structured correctly with your advisors.
Okay, that's a really helpful overview of reverse exchanges and their specific dangers. But let's circle back now. You mentioned something earlier that the sources seem to highlight as maybe the single most critical but maybe most overlooked mistake in any 1031 exchange, forward or reverse.
Yes. This point comes through loud and clear from multiple sources, and it's frankly a bit scary. Choosing the wrong qualified intermediary.
But we already established you have to use a QI. So how can choosing the wrong one be so bad they just hold the money and do paperwork right?
If only it were that simple. Here's the shocking part the sources reveal. In most states, the qualified intermediary industry is largely unregulated.
Unregulated?
Yeah. They're typically not licensed like banks or brokers. There are often no requirements for them to maintain minimum capital reserves, no mandate for them to be bonded or insured. Basically, in many places, almost anyone can hang out a shingle and call themselves a qualified intermediary.
Wait a minute, you're telling me someone with basically no oversight can hold potentially millions of dollars of my money during a 1031?
That's the stark reality in much of the U.S. And that's precisely why choosing your QI isn't just, picking a service provider based on price. It is a critical risk management decision. You are literally entrusting your sale proceeds and the success of your tax deferral strategy to an entity that might be operating with very little safety net or oversight. The sources basically say you need to view selecting a QI as actively managing significant financial, technical, and administrative risk.
Okay, that puts it in perspective. What are the main risks that come directly from the QI themselves?
The sources really boil it down to three main areas of risk. 1, lack of technical expertise or experience. If your QI doesn't truly understand the complex rules, they can easily make mistakes in the documents or the process. And often these mistakes aren't discovered until it's too late after a closing, and they can completely disqualify your exchange. You need a QI with deep experience, specialists who've seen it all and can spot problems before they happen. 2, administrative errors or omissions. Even if they know the rules, people make mistakes. Simple human error. Maybe they miss a deadline filing something, use the wrong language in an assignment, mishandle the funds transfer. These kinds of administrative slip-ups can also lead to a failed exchange. 3, and the scary one, theft, embezzlement, or misappropriation of funds. While the sources suggest this is rare, especially with larger, well-established institutional QIs, the risk absolutely exists in an industry holding billions with limited regulation. A dishonest or financially shaky QI could potentially steal or misuse client funds. There have been cases.
Okay, that's stressful to think about. So how does an investor protect themselves? How do you find a QI who is actually safe and competent?
The sources are very direct about this. You have to do serious due diligence. Do not just pick the cheapest option. Look for signs of professionalism and stability. Key things to look for and ask about are strong internal controls and procedures, fidelity bonding, which specifically protects against employee theft or embezzlement, and critically, errors and omissions insurance, often called E&O insurance.
Okay, errors and omissions insurance. How is that different from bonding?
It's a crucial difference, and the sources actually argue E&O might be more important for the average investor's protection. Bonding typically covers intentional bad acts, like an employee stealing money. E&O insurance, on the other hand, covers losses that happen because of the QI's unintentional mistakes, negligence, errors in judgment, administrative screw-ups, omissions in the paperwork. Basically, it covers human error that leads to your exchange failing.
And given that complexity, human error seems maybe more likely than outright theft at a big firm.
Statistically, yes. Administrative mistakes or technical errors are probably a more common risk than deliberate fraud, especially with established QIs. And E&O is the insurance that protects you from that risk.
Is E&O insurance standard for QIs? Do they all have it?
Well, this is another concerning point from the sources. Apparently, getting good E&O insurance, especially with high enough coverage limits to protect the large sums involved in 1031s, is difficult and expensive for QIs to obtain in this specific industry. So many QIs might have very low limits, inadequate coverage, or potentially none at all. That leaves you, the investor, exposed if they make a costly mistake.
Wow. Okay. So when I'm vetting a potential QI, what specific questions should I be asking according to these sources?
Get concrete answers. Don't let them be vague. Ask them point blank. What are your fidelity bonding coverage limits? What are your errors and omissions, E&O insurance coverage limits, per claim, aggregate? Crucially, do these insurance policies cover just the main QI company, or do they also explicitly cover any related entities, like those special purpose entities, SPEs, used in reverse exchanges that might hold title or funds? You need coverage wherever your money or title might be. Ask about their team. How long have your main HANA 31 exchange specialists actually been doing this? What's their background? What kind of complex transactions have they handled?
Okay, get specifics on bonding, E&O limits, entity coverage, and team experience.
And here's the most important verification step. Don't just take their word for it on the insurance. Ask for copies of their current insurance binders or certificates of insurance.
You get the actual documents.
Yes. Review them carefully. Check who the insurance carrier is. Is it a reputable one? What the exact coverage limits are, and what the policy period is, make sure it's current. And the sources even suggest, if possible, taking the extra step of contacting the insurance agent listed on the binder to independently verify the coverage details.
Wow, calling the insurance agent yourself. That's serious due diligence. But I guess it makes sense if they're holding potentially millions of your dollars and your entire tax deferral depends on them not messing up.
It's absolutely vital. The unanimous conclusion from the sources is never, ever cut corners when you're choosing your qualified intermediary. Your money and potentially hundreds of thousands or millions in deferred taxes are riding on making a safe, informed choice. Pick someone experienced, financially stable, with robust controls, and critically, with adequate, verifiable insurance. It is the single biggest point of vulnerability you control in the whole process.
This whole deep dive has really hammered home just how many tiny details, how many potential tripwires are packed into a 1031 exchange, even for people who've done them before, it sounds like.
It really is a minefield if you're not careful. Successfully getting through a 1031 means mastering those details and actively avoiding these critical mistakes. We've covered those bedrock requirements, that strict qualified use and showing your investment intent, the broad like-kind rule for real estate, and hitting those specific targets for value, equity, and debt to avoid taxable boot.
Right, and we hit those absolute deadlines, the unforgiving 45 calendar days to identify, the 180 calendar days to acquire, and that tricky tax return extension interaction for late-year sales. Plus, the huge mistake of accidentally getting actual or constructive receipt of your own funds and the tangles you can get into with properties owned by partnerships or LLCs.
Exactly. And we also dove into the added complexities of reverse exchanges, why you might use one, but also why they're harder, costlier, riskier with that ET parking title, the different structures, their own deadlines, and why looking at simpler alternatives first might be wise.
And then we landed on what feels like the linchpin, the absolute necessity of picking the right qualified intermediary, understanding the risks because they're often unregulated, and doing that deep dive vetting on their expertise, their controls, their bonding, and especially verifying their E&O insurance. That seems paramount.
Yeah, the consistent theme across all these expert sources is really clear. The rules are incredibly strict, the deadlines are absolute, and trying to do a 1031 without assembling and relying heavily on your expert team, that specialist 1031 tax pro, good legal counsel, maybe a financial advisor, and a thoroughly vetted, safe, insured QI, it's not just risky. It's honestly setting yourself up for failure and facing that huge unexpected tax bill down the road. Proving your intent, documenting everything, and letting trusted professionals manage the process meticulously are just essential.
So it leaves you with this final thought, doesn't it? The 1031 offers this incredible power of tax deferral. this engine for wealth building. But it's balanced against this incredibly complex, unforgiving process with strict deadlines and, maybe most unnervingly, reliance on intermediaries who might be operating without much of a regulatory safety net in many places. Does that massive potential reward sometimes lure investors into taking on more complexity, more administrative burden, and frankly, more risk than they fully realize or are truly equipped to handle on their own? It really makes you wonder, are you truly prepared for that high-wire act? Or is accepting the need for and cost of that full expert safety net just part of the deal for anyone serious about using this powerful strategy successfully?
That is definitely the question every investor needs to ask themselves before they leap.